All right, you ready?
Do it.
Welcome back to the Mortgage Chatter. I'm one of your hosts, Tyler Kornhauser.
And I'm Ken Land. Hope you're doing great today.
Yeah, thank you for joining us. We've got a very special topic this week. No special guests, but the LE versus CD.
Oh,
Yep,
you use an acronym.
I did that intentionally. Yep. So
what's an LE?
The LE is the loan estimate, or the initial document that pretty much outlines the entire mortgage for what you've signed up for. So
When do you receive the loan estimate?
It should be very soon after you're under contract. I believe it's 3 days.
You go under contract, you go into the official application as part of the RESPA package.
Yep.
3 days.
3 days. This was it's actually new. I don't want to date you too much, but the loan estimate didn't start being the document of use until 2015. There's a good faith estimate and then a truth in lending document that came before the loan estimate. I'm not sure if you want to touch on those a little bit.
Yeah, after kind of the financial meltdown, so to speak, and government got very, very involved with lending. Mm-hmm. Prior to that, you had a good faith estimate and, like you said, the truth in lending document. And our friends in Congress and whatnot, not a political statement, but they decided to make some changes. And in their opinion, the good faith estimate was not as clear. Mm-hmm. They felt that the truth in lending statement was not as clear. So they combined those two documents and basically took documents that were just a couple pages and turned them into about a 5-6 page document. Typical government work, right?
Yeah.
But the whole intentions of the LE, up front is to, show what the cost is going to be so a client can go out and shop, right? Mm-hmm. And then, of course, the closing disclosure, the CD that you mentioned, that one is going to be provided within 3 days of closing. And again, that's going to give you your final figures for the actual closing itself. Now, the ideal situation is your loan estimate and your closing disclosure should be pretty darn close.
Hopefully, right? Yeah. If anything, the closing disclosure is a little less than the loan estimate, right?
That's what I always shoot for. It's better to scare somebody with the numbers at the beginning and they all come in lower. That's
definitely
how I've said is shoot high and then let the numbers come in lower, as opposed to, and this is where when you're out there looking at homes and talking to lenders, you need to be clear with, because some people try to present pretty numbers to make you feel, oh, this person's cheaper.
Definitely.
And part of what we're going to talk about, and full disclosure, this is kind of a hard topic to discuss because we're going through a document, but rumor has it we're going to have this document posted so you can actually look at it as well.
We will have it out there some sort of way. We haven't figured out the kinks of it yet, but it will be accessible. So
exactly. But again, the closing or let's start with the loan estimate. That's a document you're going to get up front. Mm-hmm. That's when you have an official application. This is more of a quote, so to speak, from the lender. They've pulled your credit and everything. So, let's kind of talk through that one first.
For sure, yeah. I like how we were talking about it, where it could the first page could be broken down into thirds. The first third is obviously at the top, but it's going to have a lot of your personal information, like your name, the subject property, the sales price point, as well as the date. That's important. But it's also going to have the outline of what kind of program you're using. Is it conventional? Is it FHA, VA, USDA, the term length, and a big important thing is if your rate is locked, will be on there too. Yeah. So if your rate is not locked, tune into one of our other episodes about floating or not floating.
Exactly.
But we won't touch on that too much here. And that's pretty brief of what the top third is, really. Not really too many numbers, just more or less what's going on, right? The layout of everything, the lay of the land. So
exactly.
Jumping into the second third here, it's almost like it's 3/5 and the other two are 1/5, but for the sake of conversation, we'll do it in thirds. The middle third, second third, is really, it's going to have your loan amount, it's going to have your interest rate, and then the monthly principal and interest payment. That's important to know because that monthly principal and interest is based off your loan amount as well as your interest rate, and it's not including the mortgage insurance, if there is any, or taxes and homeowner's insurance. So that's the half of the second third is going to really break down that payment. If you've got mortgage insurance, It'll include that with the principal and interest, as well as escrows for homeowners insurance and taxes.
Right.
And it's going to break down that total payment there. And that's still a projection at this stage, right? If you're working with a good loan officer, they would have pulled tax records, so they should have a pretty decent idea of what those taxes will be.
Right.
Mortgage insurance shouldn't really change too much between the start and the end of the loan process. The conventional mortgage insurance quotes, they change daily, correct? Or
mortgage insurance quotes? They can.
Okay, yeah.
Depending on the situation.
I figured it was like interest rates, where depending on what's going on in the market, the mortgage insurance can change plus or minus for a conventional. FHA, VA, USDA, those are relatively, as long as the loan amount doesn't change too much, those should be accurate. And then the only real estimate at this time on the projected payment should be the homeowner's insurance. Simply because there's a lot that goes into homeowners insurance. You can tune into one of our older episodes for a homeowners insurance tutorial, but we ballpark based off what we've seen recently in the market and with other quotes, and that's how we get our higher estimate, is what we like to do up front.
Right.
And that's the middle third there, and then the bottom third is going to have the whole closing cost number, all your closing costs broken down on the second page. And then your down payment plus the closing costs for your total cash to close amount. Because nobody does anything for free, so there is other fees on top of your down payment for the mortgage. So
exactly, and that's good. I mean, the first page is kind of that high level summary, and when you are shopping around, this is a good one to kind of make certain you're comparing apples to apples, right?
Definitely.
Because like I said, at the top, it's going to tell what program the loan officers put you in, so you can make certain you're comparing, because you can't compare an FHA loan to a conventional loan, or vice versa. But you did bring up an important thing that I like to circle back on for a second. It does mark whether your rate is locked or not.
Definitely.
So when you're talking to your loan officer, and like Tyler said, we've got an episode about floating and locking, but if you think your rate is locked, right, and you get your loan estimate, and it's at the very top, it's got a box that says rate lock, yes or no, and it will tell you for how long. Make certain you pay attention to that, because that's where, again, if you're working with somebody that may or may not be looking out for your best interest, or maybe they made a mistake. I mean, it's a good way for you to double check and get that peace of mind that, hey, look, your rate is locked. Because if this document says your rate's locked, then it's locked. If the lender forgets to do something on their end, that's on them, and they got to honor it. So
definitely,
would definitely encourage you to pay attention to that. And then, of course, the note rate on there. Make certain that those numbers match up with what you're expecting. The note rate is what your monthly payment is actually calculated at. There's another interest rate called the APR, which is more of a total expression of the cost of the loan. It takes your note rate and all your closing costs, the term, any fees associated with it. Basically, and this is a very generalized definition, but it basically is the total cost of your loan. It's interest rate plus fees, etc. It just expressed in an interest rate form, which enables you to be able to shop around as well and compare. Because the higher the fees, the higher the APR is going to be.
Exactly.
So if somebody tells you their note rate is 6.99 and the APR is 8%, but then somebody else tells you, hey, I'm at 7.25 and the APR is 7.5. That's the better deal.
Definitely, yeah.
Something to consider.
And the APR is one of the best ways to compare apples to apples when you are shopping around. So based off of the exact same loan parameters, depending on which company has the lower APR with the exact loan parameters, would in turn show you which is the better deal over time.
That's right.
Not instant gratification in some cases, but
right.
And then the APR. So a few things go into the APR, like Ken said. You got the interest rate. A lot of it is the origination costs, and then you've got other things like mortgage insurance premiums and all that fun stuff. So across the board, APR should be relatively similar. The only real thing that us lenders can control is going to be the A section of the loan estimate, which is the first section on page 2, which is going to start breaking down those closing costs as well. So,
no, exactly. And like I said, I mean, page 2 is more going to be the itemization, and we're not going to go line by line. Don't worry. Especially if you're driving in a car, you're like, what in the world are they talking about? Just know the second page of your loan estimate and closing disclosure is more the itemization of what the costs work out to be. And again, we're going to go back to shopping purposes a lot on this podcast. I can already tell. Your fees for the most part from lender to lender. When you look at attorney fees, inspections, that's all going to be the same, right? Your insurance, obviously the estimate up front is going to be best guesstimates, but by the time you go to closing, it doesn't matter what lender you close with, the attorney fees are going to be the same because they don't charge based on lenders, right? Your insurance is going to be the insurance, blah blah blah. Taxes are going to be taxes.
Definitely.
The really big section you need to focus in on is the one you said. On the loan estimate is Section A, which is your loan costs, your originations, right? That's going to drive the bulk of what's going to be different. Is how many discount points or what fees are associated with that, verification fees, commitment fees, right?
Processing fees, underwriting fees, origination fees, all that fun stuff. So,
and I'm not saying don't look at the other fees. I'm just saying that the bulk of pretty much everything else is going to be the same no matter what lender you look at.
Exactly.
You just need to compare your lender fees.
There are certain tolerances to those fees. So like the origination fees, for example, there's a 0% tolerance, meaning those can't go up for any reason throughout the mortgage process. Then you've got stuff like the title fees mainly, where there's about a 10% tolerance on those. So for round numbers, if you've got $1,000 in title fees and one fee is $50 and goes up to $100, you technically are still within that 10% because it's the total of that 10% rather than that one line fee. So, and that's another spot where we definitely estimate high up front, scare them with the numbers initially, and then everything should come back lower when it's time for closing. So,
and from a lender standpoint, the title fees, part of why we say we're going to go a little bit higher is up front we have no clue who the attorney is going to be.
Yeah.
Right. So
each attorney is different.
Every attorney is going to be slightly different. They're roughly the same, but better to err on the higher side of what we've seen out there as opposed to, again, trying to make. And there's people out there who try to make the numbers look as low as possible. And my old philosophy is it's a lot easier to come down than it is to go up.
Definitely. So, absolutely.
I've never seen anybody happy when suddenly their closing costs increase.
Yep. Even if it's a few hundred or a couple thousand, it's definitely better to go down than up in that instance for sure. So
True.
But that's a pretty brief run through of the loan estimate there. I will touch on the escrow fees. There's no tolerance for those simply because we don't know what the homeowner's insurance is going to come out to be. The taxes could go up or down depending on the year. Typically they go up, but and
when you're saying taxes going up, I'm not talking about the amount, just more of what's being collected.
Exactly. Yeah. So those fees don't have any sort of tolerance. They can go either way as they wish. But
and if you're doing a purchase, you always want to look at, in a way to kind of gauge it a little bit, is there's always going to be, when you set up that escrow account, which is again that savings account that's going to budget and handle your taxes and insurance being paid out, they're always going to have a couple months worth of reserves, right? And kind of a red flag to look for is if, again, a way some people sometimes try to pad numbers to make them look great to convince you to go with them is, suddenly they're only padding, maybe 1 month, or it's a low number for whether it's both taxes and insurance or just one or the other. In all reality, there should be about 2 to 3 months worth of taxes is being collected, or insurance, and then I usually go ahead and say like 3 to 4 just to be on the safe side with the taxes.
Definitely.
Just to, again, allow enough of a cushion in there and roll from there. But that's also driven, like you said, for whenever you close, what time of year.
Exactly. Yep.
So,
definitely.
Yay.
So that's rough idea of the loan estimate there. So in this scenario specifically, you got about $14,351 in closing costs altogether, and then about $40,251 in the full cash to close. Assuming that off a $369,000 price point with 10% down, and then there's also about $11,000 in earnest money there. So earnest money does come out of that final cash to close number. You already paid it once. There's no point to pay it again. So that's kind of where we're coming up with these numbers for this specific scenario. So jumping over to the closing disclosure, page 1 looks almost identical to the loan estimate. So
and that was one of the things that when they passed this law, the document, or whatever you want to call it, right? One of the things I do agree with, I always like the good faith estimate personally better, but One of the things I do like about having the loan estimate and then the closing disclosures, it's basically the same document. It's called different things, but the format is the same, meaning for a borrower, consumer that's, especially first-time home buyers, this is completely new to, right? The document they look up front at for closing numbers, cash to close, and all that is basically the same document they're looking at the closing table, especially the front page, right? I mean, it's the same form. So it does make it easier. And again, going back to what we talked about, realistically, this loan estimate and the closing disclosures, this front page, it should be pretty darn close.
Definitely.
Now, this example that we got here, this is a loan that you did not too recently.
Correct.
Just not too bad. Closing costs. So, sign of a good loan officer. I'm going to call you out here, right?
Oh, shucks.
No. So, your monthly payment worked out to be the exact same. Again, the same document. You get your loan amount, interest rate, principal interest payment. So, it stayed the same. Your principal and interest payment was a little bit higher with the taxes and insurance being put in there, but I'm assuming your insurance quote was probably a little bit
The
higher.
insurance did come back a little higher. Initially, it was a lower priced house. So that did play a little bit into it.
Nice.
So once we got the actual homeowner's premium, it was, I believe it was $5 more.
Yeah, it's not a big difference. We're very close on the payments, so good job. But again, you always want to make certain that it's close. But then the cool thing is, and what makes very happy, is your estimate on the closing costs were a bit higher. I mean, you had about 14 and change here, and the closing disclosure, the closing cost came in around 12 and change. So very good number.
And that's part of where we like to estimate high. So
now, there is a big question I have here. Your loan estimate has $40,000 due at closing, but your closing disclosure only has $13,600 in closing. You want to share how that came up?
Definitely, yes. So that's why I picked this specific example. Initially, it was about $40,251 to be exact, cash to close. But this is before the gift from a relative. So that cash to close, that cash to close that you bring will be minus your gift amount. So you take that full gift amount as well as that earnest money, and that's what gets you that cash to close number, as low as it is and as low as it came out to be. So
always good to have a rich uncle.
It is.
Get a gift,
definitely.
Make your cash to close a little bit lower.
Exactly.
Remember, gifts are acceptable forms of down payment or closing cost money. So there you go.
But other than that, page 1 of the closing disclosure looks almost identical to the loan estimate. Obviously, minus the gift, and any seller credits or stuff like that would come out of the cash to close as well. But jumping over to the second page, it almost looks identical. Instead of doing it with 2 columns, though, there's about 1 column, I'd say. Yeah, I don't know why that was so hard to say, but it was.
High math.
Yep. Well, I was dividing in half, and that was difficult.
No. So, yeah, this page 2 is going to be a very detailed breakdown of the line items of everything, of lender costs, credit reports, the exact attorney fees, and again, not to go through line by line, but it goes back to your tolerance levels as you talked about before. Some of these fees that on that front end loan estimate cannot change. For example, the commitment fee. The lender's commitment fees, in this case was $12.95. It's a $12.95 on the loan estimate. It has to be $12.95 on the closing disclosure.
Exactly.
So, because those cannot change. But good job on this.
Thank you. One thing I will point out on the final closing disclosure, because it does not translate to the loan estimate necessarily, are things you may have paid before closing, as well as any adjustments that are made. So we charge the appraisal up front. The appraiser won't go out and do his work without getting paid. I don't blame him. So we charge the appraisal up front, and obviously on the initial loan estimate, it's going to be calculated in that full cash to close amount. But similar to that earnest money, you've already paid it, so there's no point in paying it again at closing. So there's 2 columns there, and it would be not credited back to you, but deducted out of that final cash to close amount.
Yeah, you only had to pay for it once.
Yeah,
you're not going to charge you twice.
And if you do get charged twice, then someone took your money.
Exactly. And then there is another column on here. So you got your borrower paid fees, and then you got some are at closing, some are outside of closing. But then you also have your seller paid sections as well. So this particular scenario that we're looking at here, I guess they were lucky enough to get a pretty nice little credit closing cost credit. So some fees were actually paid for by the seller. So, as you as a consumer, and your loan officer is going to go through this with you at closing, but you can kind of go back through and reconcile, making certain that you got all the credits that you were supposed to get as well.
Exactly,
So,
definitely, yep.
Yay.
And then there's a paid by others as well. If there's any realtors taking a commission hit for you or lender credit, that would go in that section. But then I do want to talk about the initial escrow payment section. There's what's called an aggregate adjustment for it.
Oh, I would love to hear you explain this one.
Definitely. And it does not translate to the loan estimate. So it's a way to make sure there's enough money in your escrow accounts to pay those bills when they become due. Legally, we cannot have more than 3 months of each escrow in escrow collected. So, for example, this property tax section is collecting for 10 months, but then there's a large aggregate adjustment to refund for that. So we want to make sure there's enough money in your property tax escrow account to cover taxes when they are due, but we don't want to over collect for them, which is in that big formula to get that aggregate adjustment. So here we almost have $1,000 credited back through that aggregate adjustment that would not be seen on the loan estimate, just due to translation issues. But other than that, it's
very well explained, by the way.
Thank you.
There's an equation.
There is an equation, and there's a lot of math and numbers that go into it. It's like the APR.
We let the computer tell us.
Yeah, we know the gist of it, and exactly. The actual formula is a little too long and out of my pay grade.
Exactly.
But similar to the loan estimate, all these numbers will come together and give you that grand total of the closing cost line, and that's all your closing costs that you're paying without that down payment being assumed in there as well. So,
correct. Yeah, my favorite page is actually pages first, and then what would be page 3 of this thing is
definitely
because it does a comparison of the loan estimate and the closing disclosure at the top. But what I like is this bottom section that does a break. It's like a bird's eye view of the whole transaction, right? And it's all on one page. And the funny thing is this is really more how the good faith estimate was back in the day.
Okay.
Right? So you had the transaction summary basically, or I guess really wasn't the good faith. It was the HUD. We use that at closing, the HUD disclosure instead of the CD. But it breaks it down. You got your price, you got all the costs. So you got your purchase price and you get your closing costs. If you're being charged any taxes at closing or HOA fees at closing or anything like that, that'll all be at the top. And then you got all your credits down here at the bottom. Mm-hmm. Credits and debits, boom, 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 boom. And then you got your cash to close number.
Yep.
So again, a great way for you as the buyer to double check and make certain things the way they are. You look at the bottom and make certain that you do have your credit for your gift. You do have your credit for your seller, closing costs. But then there's also, to go with your little aggregate adjustment conversation, the adjustment for items unpaid by the seller. We set up the escrow account. It's going to decide how much you get and how much goes into it or not. But then there's this credit that comes from the seller on that page that shows their portion of the taxes that are being collected, right?
Mm-hmm.
You're not going to pay taxes. Fair. Yeah, well, you don't pay taxes on the house when you don't owe it, right?
Exactly, definitely.
So this closing happened when?
2 months ago.
On 5/22. Yep. So there's a credit down here.
Literally 2 months ago today.
Bingo. So there's a credit on here for $1,000 basically that kind of matches that aggregate adjustment, doesn't it?
Exactly, yep.
So there's your offset. The seller's going to give you a credit for the taxes, again, for the time that you didn't own the house.
Exactly. So I like that actually, because touching back on the aggregate adjustment, so for that 10 months, you are getting a credit for nearly half of that 10 months collected. And that, like I said, that was just to make sure you have enough money in those escrow accounts for when taxes are due, because you do not want an escrow shortage and have to cough that money up out of pocket. No. That is not fun.
No, it's a little surprise.
I'm sure, definitely. And then you got the back pages. It's really just additional information. You got the contacts for the whole transaction, and a little bit of breakdown there, but that's the main juice of it. I think these are the two probably most important documents throughout the whole loan process. They really outline everything for you. And
and the closing disclosure is a document you want to definitely hold on to. Your CPA, your accountant's going to want it for taxes.
Definitely.
There are some fees on here that you may qualify. I'm not giving tax advice, but you may or may not qualify to be able to include in with your deductions. But it's also just a good document to have because it shows that you bought the house. It's your closing disclosure.
Yeah.
I know some schools want it if you're rezoning, going to a different school. And there's been various times I've had to pull it out and provide for things. So it's a good little document to keep.
Definitely.
And hold on to.
And with that, the tax deductions, we're not CPAs, but I heard with that big, beautiful bill that there's new mortgage insurance benefits.
There are people that can write off their mortgage insurance again. Back in the day, you could. Now you can again. So
important to keep this document. And your loan officer should always have a copy if you ever need it. So I know I send mine out every tax season just in case, and make sure everybody's taken care of in that sense. But
Absolutely. But as you're looking at the documents, this is something you always want to circle back with your loan officer and ask questions on. If it doesn't make sense on here, ask. Because the last thing you want to do is be sitting at the closing table trying to figure out what something is or what a fee is or anything along those lines. And ideally, I know with us, we're averaging about 8 days early on getting the closing disclosures out.
Yep.
So plenty of time to discuss, go through, make certain transfers, wires are done. And your loan officer should always review this thing, prior to you being at the table.
Definitely.
Don't find yourself looking at the closing disclosure for the first time at the actual table.
Big boo boo.
Big, very much so.
Like you always say, I mean, it's about that monthly payment and cash to close. So initially with the loan estimate, we go through those fees. Not many can change in our power. So if they do go up or down, it's outside of our control. But that ultimate cash to close and that monthly payment should all make sense and be comfortable with you come that closing disclosure. So if something doesn't look right there, it's definitely a red flag and something to ask about for sure.
Raise your hand. Hopefully this helps. Hope it's as clear as mud.
Yeah.
All right.
Yeah, definitely. We're always happy to roll through a closing disclosure loan estimate for you.
Anytime.
If you're shopping around and just want some expert opinions, we'd be more than happy to go through it line by line if you'd like. But typically the big sections are going to be the A and B section that you're going to want to pay the most attention to when it comes to shopping. Other than that, I think we hit them pretty well on the head.
Good job, sir.
Yeah, thank you. You as well.
Hey.
Got to talk about the GFE there for a little bit.
Oh, blast from the past.
Right?
So, you date me so much.
It honestly wasn't that long ago, though. I mean,
nah, it wasn't. But thank you so much for joining us, and keep the questions and feedback coming in. Thank you much.
Cheers.
Cheers.